From fixed rate to FHA and jumbo loans, discover 25 types of real estate mortgages every buyer, investor, and homeowner should know. Whether you're buying your first home, refinancing, or investing, knowing the different types of real estate loans can save you thousands. In this video, we'll break down 25 types of mortgages so you'll know exactly which one fits your goals. Fixed rate mortgage, which means a loan with a constant interest rate and monthly payment throughout the loan term. For example, a 30-year fixed mortgage at 5% means your payment stays the same for 30 years. Adjustable rate mortgage, ARM, which means a mortgage with an interest rate that changes periodically based on a financial index. For instance, a 5/1 ARM has a fixed rate for 5 years, then adjusts annually. Interest-only mortgage, which means a loan where only interest is paid for a specific period, after which principal payments begin. For example, paying only interest for the first 7 years, then starting to pay principal. FHA loan, which means a government-insured loan that allows lower down payments and easier credit requirements. For instance, FHA loans are popular with first-time homebuyers. VA loan, which means a mortgage guaranteed by the Department of Veterans Affairs, often requiring no down payment. For example, veterans can get VA loans with competitive interest rates. USDA loan, which means a loan backed by the U.S. Department of Agriculture for rural property buyers, often with no down payment. For instance, buyers in eligible rural areas qualify for USDA loans. Jumbo loan, which means a mortgage exceeding conforming loan limits, usually requiring higher credit scores and down payments. For example, buying a luxury home often needs a jumbo loan. Balloon mortgage, which means a loan with small payments initially and a large lump sum payment due at the end of the term. For instance, a 7-year balloon mortgage requires full repayment or refinance after 7 years. Reverse mortgage, which means a loan for homeowners 62 plus that converts home equity into cash, repaid after selling or moving. For example, seniors use reverse mortgages for retirement income. Construction loan, which means a short-term loan used to finance building a new home or property. For instance, funds are released in stages as construction progresses. Bridge loan, which means a short-term loan used to bridge the gap between buying a new home and selling the old one. For example, you use a bridge loan to buy before your current home sells. Conventional loan, which means a mortgage not insured or guaranteed by the government, often with stricter requirements. For instance, most borrowers with good credit use conventional loans. Conforming loan, which means a conventional loan that meets Fannie Mae or Freddie Mac guidelines and loan limits. For example, loans under $726,200 in most areas are conforming. Non-conforming loan, which means a loan that does not meet Fannie Mae or Freddie Mac criteria, including jumbo loans. For instance, loans exceeding conforming limits are non-conforming. Second mortgage, which means an additional loan taken out on a property already mortgaged, often with higher interest rates. For example, homeowners use second mortgages for renovations or expenses. Home equity line of credit, HELOC, which means a revolving credit line secured by home equity with variable interest rates. For instance, you can borrow up to a credit limit and repay multiple times. Home equity loan, which means a lump sum loan using home equity, usually with fixed interest and payments. For example, you take a $30,000 home equity loan for a kitchen remodel. Interest-only ARM, which means an adjustable rate mortgage where you pay only interest for an initial period, then principal and interest later. For instance, lower initial payments that adjust after the interest-only period. Graduated payment mortgage, which means a loan where payments start low and increase over time, helping borrowers early on. For example, payments rise annually for 5 to 10 years before leveling out. Piggyback loan, which means two loans taken together to avoid paying private mortgage insurance, PMI. For instance, an 80 to 10 loan with 80% first mortgage, 10% second mortgage, and 10% down payment. Interest-only balloon mortgage, which means a loan with interest-only payments and a balloon payment at the end of the term. For example, paying interest monthly for 5 years then a large final payment. Assumable mortgage, which means a mortgage that can be transferred from seller to buyer under existing terms. For instance, buyers can take over low-rate loans in assumable mortgages. Wraparound mortgage, which means a secondary loan that wraps around an existing mortgage, combining balances. For example, a seller finances a buyer by wrapping a new loan around their existing one. Shared appreciation mortgage, which means a loan where the lender gets a share of the property's appreciation in exchange for better terms. For instance, the lender receives a percentage of future profits when you sell. Open-end mortgage, which means a mortgage that allows additional borrowing up to a credit limit without refinancing. For example, you can increase your loan amount later for renovations.